Okay, our next speaker, another Greg Bittar, who is the newly appointed Chief Executive Officer of Lotus Resources. Lotus, as everybody knows, acquired the Kayelekera asset from Paladin a few years ago and has been working through getting a mine development agreement, which was recently signed with the Malawi government, and making a number of operational improvements to that asset, which had a somewhat of a checkered past historically, with issues around acid and power costs, etc. And Greg can talk us through some of the improvements that they've identified that they can make to that operation. And also, I think Greg, one of the key things now is that we've heard in all the presentations today the market opportunity that's appearing in the uranium space. Really later this decade, 26 through 30. So I'm sure you are now sort of changing your focus slightly to be, how quickly can we get Kayelekera back into production, and how can we take advantage of this price environment we're all expecting to see in the next few years? So over to you.
Absolutely, thank you, Andrew. Certainly, no doubt, many of the participants or people listening to this call are familiar with Lotus, but just by way of background, I joined Lotus mid this year, was appointed CEO last month as part of a number of board and management changes to ensure, as you say, the requisite focus, both technically and commercially, on getting into production as soon as possible with Kayelekera and the development of our second asset. As you mentioned, we are finalising the work to support an accelerated pathway to production, or an accelerated production strategy, which we will be releasing to the market shortly. And hence, I'll bear with me without a presentation for this discussion. And we'll be releasing to the market a presentation that outlines our strategy in the not too distant future, certainly sometime in October. By way of a brief background, Lotus shifted its strategy to uranium in 2020 with the acquisition of Kayelekera. This is a Malawian-based project. We have a second, more recent project that was acquired late last year, a project in Botswana called Letlhakane. We're certainly very comfortable with these projects being in the respective African jurisdictions. Whilst Malawi is not very well known, and Botswana is more well known, but Malawi is a Commonwealth country. The foreign policy there is considered quite pro-Western, with a judiciary based on English law, certainly a lot easier to do business with the English language. There's strong support in Malawi from international donors, from the IMF, from the World Bank, and from Western governments. And the Malawian government is now increasingly reliant upon mining as one of its three pillars: mining, agriculture, and tourism, to try and spur on economic growth. One final thing I will mention about Malawi is we've seen recently Rio Tinto invest further into sovereign metals, which holds a large rutile project, probably one of the largest globally in Malawi, and that's an exciting development that we're all focusing on, or will help the development of the mining industry there. Our second project in Botswana, obviously, Botswana better known to Australian investors through Sandfire and other projects, very highly rated on the Fraser Institute survey as being one of the top mining jurisdictions globally. So very comfortable with the two jurisdictions in Africa, certainly relative to some of the other African jurisdictions that are far more problematic. In March 2020, the Kayelekera project was acquired from Paladin. Under Paladin's previous ownership, Kayelekera actually was in production from 2019 to 2014. Over that time, it produced about 11 million pounds. That was principally sold into the spot market until Fukushima and other aspects of the uranium price market then led it to being uneconomic, and it was placed on care and maintenance. Since that time, the plant and infrastructure remained in place. There's been an on-site workforce, and components of the plant have started up regularly throughout the year for purposes such as water treatment and other checking and operational requirements. So parts of the plant have continued to be operated during that care and maintenance period. All of the mining and environmental licenses remain in place. And as you mentioned, Andrew, in the introduction, we recently finalised the mine development agreement with the Malawi government. Whilst this wasn't technically required for us to restart operations, certainly important in providing a clarity around the fiscal regime for the project and legal security around the tenure. So essentially, the MDA guarantees us stability for 10 years. We will not be subject to any detrimental changes in the fiscal regime through that period, and allows us to get on a plan and having aligned the economics around the fiscal regime with the DFS assumption. So it's a fairly standard 5% royalty rate, a corporate tax rate, although we get the benefit from the accelerated capital depreciation, such that we won't be in a position to be paying corporate tax for the first couple of years. We get relief from resources rental tax. We get relief from withholding tax as it might apply to dividends to non-residents. So that gives us the flexibility to move cash flow around and to support funding or provide funding for our second project. Kayelekera is a restart project. Following the acquisition in 2020, Lotus proceeded down the path of formulating its definitive feasibility study. That was completed in August 2022, and it focused on the restart, but how do you optimise the operating costs looking forward and learning from the way it was operated previously. Being a restart project, it is quite unique in the world of uranium development projects. We are talking a very short runway to production, and hence we're very keen to be able to turn the plant back on and meet what is a very buoyant medium-term uranium supply deficit. There aren't too many sizable restart projects or indeed new builds that are going to come online in the next 4 to 5 years. You heard earlier from Peninsula about Lance in the US. There's a few other smaller ones in the US. Energy Fuels has got several, but by the time you aggregate their 3 or 4 projects, assuming they all come online with the production they forecast, you're still not in aggregate at the scale of Kayelekera. Outside of North America, we've obviously seen Honeymoon and Langer Heinrich, but no others in the Western world seem to be in a position to come online during the next 3 to 4 or 5 years. Going back to the Kayelekera DFS, 10-year life of mine, circa £20 million in total of the current resource, very much biased to the first 7 years where we're forecasting £2.4 million per annum. This is an open pit, high grade, less than 3 strip ratio, quite shallow. Maximum depth at the end of the mine will be circa 110 metres. There's a little bit of land clearance to do, and we've essentially got to just re-establish the benches from a mining perspective. The plant itself is 1.5 million tonnes per annum throughput, reserve grade 660 ppm off a slightly lower resource of about 500 ppm. The feed grade is shown to improve with the adoption of ore sorting technology, which is certainly part of our plan for production, and was incorporated in the DFS. Those ore sorters really come to the fore from about year 2 of production. Beyond the current life of mine, certainly good resource growth potential from our other tenements located close to the plant site or close to the current project. The main one being a small existing resource and a tenement called Livingstonia. It's already about 300 ppm, small resource, but good exploration potential about 50 kilometres away. The 2022 DFS mapped out 15 months to restarting production. This included all of the belts and braces to optimise the operation and the cost structure to deliver the DFS all-in sustaining cost of $36, $37 a pound US. But that 15 months included having connected the long lead time or the long lead item of grid power, which is certainly critical from the cost optimisation perspective and very important long term, but we don't need to wait around for that to be able to turn the plant on. Previously, it was operated by remote diesel gensets. There was an installed base of 7 megawatts, which is still on site. Two of those units still operate, and we'll be refurbishing the others and maintaining that full redundancy on site. And indeed, we can use, and we will use those to get into production as soon as possible, and the grid connection can follow. The grid connection is obviously very important from an ESG perspective, sourced from hydropower, and the 45-kilometre grid, the 45-kilometre power line will now allow additional communities to be connected to the power grid. So it's a very popular initiative in country. Hence, our focus now is refining and articulating an accelerated plan to production, which will significantly reduce the upfront capital. The same capital components will be needed, and we're certainly not looking to avoid any of them, but it doesn't all have to happen for us to be able to turn the plant back on. Significant items such as the grid connection, the 45-kilometre power line, circa $15 million US in the DFS, the refurbished or the rebuilt acid plant in the DFS, we will be refurbishing it. It will come on post-production, and we'll obviously have to have an inventory of sulfuric acid. The ore sorters and the nanofiltration, which was a $6.5–7 million US component, they weren't utilised until month 14 or month 16. We will make sure they're able to be plugged into the plant, but we don't need to order those and pay for those up front. So, when you exclude those items line by line, almost half of the DFS's pre-production capex of $88 million US is made up of those items and can be managed over a longer period. Interestingly, the cost of rebuilding the existing infrastructure is close to about $300 million US, and would certainly be accompanied by a much longer timetable to production if that was what we had to do. So we're currently finalising the accelerated production strategy. That'll be a key news flow item in the short term. In parallel, we've been investing heavily in the team, developing our operational readiness capability. Our restart team has grown with key appointments that some of which we've announced recently, and others will be highlighted as part of the strategic relaunch. We are in the middle of mobilising site crews. We have site crews there conducting civil works and earthworks and attending to basic repairs of things like sewage systems and water filtration upgrades. Our first construction restart crew, comprising 20 personnel, arrives on site the first week of October, and that'll be followed quickly by another team. And I suspect by the end of November, we will be up to about 50 people on site. And along with all of that comes the tools, the mobile equipment, all of the kit required to get this plant back into operation. A couple of long lead items. We've got the financial flexibility on the balance sheet to have already placed orders for the calciner and the scrubber. They're key components at the back end. Unfortunately, they take months in terms of lead time. So we were very focused on ordering those. The scrubber order was placed earlier this week, and that's a 4.5 month lead time. Other areas that we're progressing, we've run a mining contractor tender process. We're down to the final two. We expect a contract will be awarded well before the end of this year, so that's more news flow. Other progress around the power grid connection. We've got the MOU with the local power company. We're well down the path of the management plan and the PPA, and we're soon to go out with an EPC tender for the construction. So the accelerated restart makes sense from a timing and capital perspective. And Andrew, as you said, it makes so much sense given the demand and the feedback we've had from the utilities who we've been in offtake discussions with. Clearly, the long-term demand price outlook is strong, and there is genuinely a willingness by these utilities to support new supply. So on the market and commercial side, our offtake strategy that I became involved in when I first joined the company in May seeks to secure a modest but meaningful first tranche of fixed price escalated contracts. We're talking up to about 30% of our production through to about 2029, 2030. So retaining a lot of spot exposure. Our focus is on the North American utilities. The pricing on those fixed price escalated contracts locks in a very attractive margin for us relative to our 2022 all-in sustaining cost per pound, but also on an escalated basis, still a very attractive margin. And we picked that level because it underpins about half of our forecast total costs. However, with the market the way it is now, the opportunity is there for our second tranche to focus on delivering upside for shareholders in uranium, upside to the uranium prices for shareholders. And as we get closer to production, we will layer in the next tranche of offtake based on market pricing. And we're seeing very attractive collar parameters being discussed with attractive floors, and those floors have moved up significantly since we started talking to utilities, or since I started talking to utilities in May. The company's been talking to them for a long time. And the ceilings are attractive in terms of the upside exposure for shareholders, and that those parameters are escalated as well. So additional offtakes also expected to be part of our news flow in the short term. Let me just quickly touch on our second project in Botswana, Letlhakane, which was acquired, completed in late 2023. Greenfield project, large resource, 118 million pounds at the moment. Recent announcements provide a sense of the project scale, both from the drilling and the further exploration, or the further infill drilling that we've done, and a little bit of step-out exploration. And it really has the potential to be the same scale as other African development and production projects that we see both with Australian companies and owned by others. The previous owner was an ASX-listed company called ACAP Energy. They completed a technical study in 2015. We came out to the market a week or so ago with our scoping study. And there's probably 3 or 4 key takeaways from that. Clearly, this is a globally significant uranium resource in a top mining jurisdiction. And that scoping study gave us improved confidence around the recoveries. The mining license remains in place, along with all of the environmental licenses and key permits. The scoping study showed that we could look comfortably at a 3 million pound per annum production story over a 15-year mine life, close to existing infrastructure, road, rail, sealed roads, etc., and a workforce that has previously had experience in the mining sector. There was a nickel project that closed down recently, so there's a workforce there to be tapped into. An open pit free dig project, and now the opportunity for us is to optimise the way we think about that project. We're continuing to do trade-off studies around acid consumption and the way we mine it. They're the 2 big costs. This is a big strip ratio, a high strip ratio because of the cut-off grade we've adopted. The ACAP technical study essentially grabbed as much as they could because they could source cheap acid from the nickel smelting operations locally, which had now closed down. So we have to buy acid, and hence we need to be more thoughtful about the acid use. This is a deep resource, and hence mining costs, and we need to think laterally about how we optimise from a mining perspective. Interestingly, and quite late in the piece, we had a desktop ISR assessment done by a group called ERM Consulting. This cleared the path in terms of there being no red flags or identified impediments in relation to ISR potential. The geological setting looks very interesting and receptive to ISR. And so without being a complete pivot, ISR and doing the work around that is becoming more exciting for us. Certainly pumpability testing will be underway, and looking then to get in field and do the in-field leach trials as we think about planning the next steps. We will incorporate the ongoing metallurgical test work and the updated resource into news flow around Letlhakane in the coming months, and certainly have a lot more to say on the ISR potential through the first half of the next calendar year. Sorry, just conscious of time, Andrew. Give me 2 more minutes and I'll wrap up. Just from a corporate perspective, Lotus obviously has a market capitalisation of close to 470, 480 million, quite volatile day to day as the whole sector is. We joined the ASX 300 earlier in the year. We had 34 million cash as at the 30th of June. We're obviously spending that, but that's given us the flexibility to place orders, to build up the team and to mobilise for the restart. Our research coverage is certainly broadening, led by your good self, of course, and we're certainly getting traction with ongoing offtake and commercial discussions. So in summary, 2 highly complementary projects, Kayelekera, which is the restart, very capital efficient, short-term horizon to cash flow, and looking to seize the market opportunity, and then Letlhakane is the longer-term, larger scale complementary project that we can use Kayelekera cash flow to develop. So with that overview, happy to take any questions if you've got any, Andrew.
Yeah, thank you, Greg. Yeah, great overview. Yeah, look, and appreciate you presenting. I know you've got your update coming very shortly, so
yeah, looking forward to that.
Yeah. A couple of questions. I look if I can preempt some of that, and I'm not sure how far I can push you on this, but Kayelekera restart. In terms of what is your thinking now in terms of where you might want to hit a final investment decision to say, yeah, we are ready to go? Is that going to be this calendar year, or is it early next year? And then a second question. I mean, clearly the restarting early and changing the parameters, like going capex light. There was clearly going to be some capex opex trade-offs in that. Because the improvements around the acid plant and the moving away from diesel generation, the nanofiltration, etc., are all going to be quite significant improvements in your cost structure for the operation. Have you got any sort of early indications for us on what in the initial year of production, what your cost structure might look like?
Yeah, so certainly. So FID, look, I've been conscious not to lose the benefit of it being a restart. So going down the DFS path and then the FID path and a whole range of other boxes that we had to tick sort of buried us in the weeds and forced us to, well, it didn't allow us to get on with what we needed to get on with, and that was trying to restart this plan. So we've essentially, by signing the MDA, the government now is demanding updates and the president wants to visit site next month. They want to see activity. We're making recruitment decisions as a producer. We're talking to off-takers, and whilst we're including flexibility in those off-take arrangements, very quickly they become binding, and that's the nature of those agreements. We've got the ability around our first year of production to pick up those pounds and push them out a year, but we're thinking and behaving now like a producer. So I'm not sure that there will be a formal FID. We've got the unsecured facility with Curzon that just allowed us to demonstrate that there's a real appetite around prepayments and potentially working capital facilities. I think we're very confident around the significant reduction in that $88 million upfront capex, such that we're getting on with it. So we're mobilising. We, for all intents and purposes, proceeding to production.
Yep.
And there is a big trade-off around the power grid connection. It's $6.25 US a pound saving from that connection. And if you assume that there's a 12-month period where we have to rely on diesel gensets, we won't produce the full 2.4 million pounds in that first 12 months with the ramp up. But if you adopted a 6 to 9 month ramp up, I think it'll be sooner, and you pick a number significantly less than 2.4, and you times it by $6 a pound, that's your one-off cost of getting into production without the risk of relying on that grid connection to time your production. I'd love to say that the contracts and the timetable will be set in stone, but we all know they won't be. And so I'd rather be producing and not be beholden to that timetable around when that construction will be finalised. We made great progress. We finalised the route, the compensation through Eskom for the landowners, just in terms of the easements required. We're not relocating anybody. It's all good progress on that front, but I don't want to have to worry about a month's delay or 3 months delay in that grid connection. The sulfuric acid plant will get significant savings from the DFS in terms of our new refurbishment strategy, as opposed to bulldozing and taking the time to relay and reset and do it all from new. But there will be 4 or 5 months where we run on imported sulfuric acid, and we'll come out with that impost in terms of the OPEX. So it is a trade-off, but I think the economics and the window to be a producer far outweighs the incremental cost on the 1.5 million pounds that might be produced during that time where we're bringing the rest of the capex online. The ore sorter and the nanofiltration weren't being used until month 14 or month 15 in any event, and that's together $7 million US. So we will still bring those in according to the schedule. We know the German manufacturer of the 2 units. We understand the timelines, and we understand the capital commitments required in ordering those. So we will make sure they're on site well before they're needed, but we don't need to sit there and fund all of that today. The camp is another one, 450 rooms. Now, we won't need anywhere near that. The way we're planning on the workforce and supporting the workforce in the local communities. The expats and the mining contractor will be on site, and we'll need about 250 rooms. We're doing that in a more systematic way, and certainly for your first site visit, there'll be some nice rooms renovated.
Excellent. Well, look, Greg, that's been terrific, and I think it's a very sensible approach, particularly if my forecast of uranium prices hitting to $150 a pound by the end of next year comes to fruition. Then whether your cost structure is $40 or $60 a pound will make no difference. So, you just want to be getting the pounds into the market. So, yeah, it's a change in approach, and I think quite sensible. So, good luck with that. We look forward to watching what you do in the next few months, and look forward to seeing Kayelekera restarting very soon.
And thank you for hosting.